This week, the Indian rupee fell to an all-time low against the dollar, falling below the 79 rupee threshold and reaching a low of 79.64 recently, signifying a weaker Indian currency against strong US dollar. In fact, the International Monetary Fund (IMF) anticipates that by financial year 2029, the rupee will lose value past 94 rupee to a dollar. But the economic question here is, why is it happening? What are its economic implications and what does this mean for India? Let us find out. Hi everyone, I am Anchal from Green Portfolio. Rupee has been losing value tremendously this year. But why? First, let us understand what depreciation of currency actually means. You must have heard people saying, "अरे यार डॉलर 77 से 79 का हो गया." When individuals and companies have to pay more of home currency, Indian rupee in this case, for $1, we call it currency depreciation. For example, your kid wants to study in US. The fees of the college is $1,000. Assuming that rate to be 77, you'll have to pay 77 into 1000, that is 77,000 INR. But in case it depreciates further to 80 rupees, you'll have to shell out rupees 80,000, a whopping increase of rupees 3,000. The basic logic that goes behind this is demand and supply. The demand for the dollar will be larger than the supply if a nation imports more than its exports. Greater imports implies companies have to pay in dollars for the products they are importing, inflating demand, which then causes the domestic currency such as INR in India to lose value in relation to dollar. Geopolitical tensions between Russia and Ukraine causing supply chain disruptions, skyrocketing inflation forcing central banks around the world to increase interest rates, rising crude oil prices, low forex reserves are a few reasons, to name a few. But do you know what is the main concept behind this phenomenon? Though exports have been declining, but foreign direct investments are experiencing an increasing trend. Feasible government policies, subsidies, greater focus on in-house manufacturing, dynamic business environment, abundant resources has made India globally competitive country. Here is when a concept called interest rate parity plays its role. For a better understanding, let's take currencies of two countries, US and India. Let's assume US gives a risk-free return of 3%, whereas in India it's 6%. As an investor, you'd obviously want to prefer India's market as an investment instrument. For this, you'll take loan from US and invest in India at 6%. Seeing this, many people will start taking loans in US, suddenly increasing the demand of dollar and thereby depreciating Indian rupee. By the time you get a return of 6%, the home currency, which is rupee in this case, would have fallen to such an extent that the real rate of return would be less than what US initially provided. Monetary tightening has triggered portfolio outflow investments. Foreign institutional investors, FIIs, are pulling out their money from the markets due to negative sentiments. Market indices are crashing. If you ask what is the government doing to control this devaluation, government has recently increased import duty on gold from 10.75% to 15% in view of falling rupee. India is the world's second largest gold consumer and country has hiked import duty on gold as the surge in imports was putting pressure on the current account deficit, that is CAD. With this, the government aims to reduce gold imports and preserve foreign reserves. Amidst all this, we cannot ignore the fact that US always acts as a safe haven during these such times. And this fall is not just rupee specific. In fact, Euro USD reaches 1:1 parity for the first time in 20 years. Unbelievable, right? Government and RBI are working together to control the inflationary pressure on the economy and help rupee restore its value against US dollar. How has the change in rupee affected you as a manufacturer or a consumer? Let us know in the comments below.